first quarter earnings season. We're looking at several sectors. Today, the spotlight is on the financial space. Motilal Oswal has come out with a report suggesting that the current year FY24 will probably start off on a pretty healthy note. But there is an expectation that we might see margin pressure from the fourth quarter onwards. We have Nitin Aggarwal, head of BFSI research at Motilal Oswal, joining in. Nitin, pleasure having you on the show. Thank you so much for joining us this morning. So let's get to the heart of this. We've already started seeing Q1 updates come in from a lot of lenders. And while most are looking at very healthy year-on-year growth at least on the loans front, quarter on quarter, deposit growth seems to be kind of easing out for a lot of the lenders, like the ones that we've got today, for instance, whether it's RBL Bank or AU Small Finance. So tell us, as we look at Q1, what are the highlights that you're expecting in terms of the key parameters this time around?
Right. So, as you said, we are starting the year on a high note. We are looking at over 50% earning growth for the banking stocks that we cover. And so both PSUs and private are likely to showcase this momentum. And it's just that over the year, we will see the earning moderation. But to begin with, I think the parameters like growth, loan growth is on track, while it's likely to moderate in 24. But if you look at the first quarter, the way it has been typically a softer quarter, the numbers are still pretty decent on the loan growth side. And liability growth across banks is a bit varied. We are seeing slower traction from some banks which have come for the business update. But that is also because some of them chose to deploy the excess liquidity, which is why they didn't really consciously focus on raising liabilities. And otherwise, at the system level, we have seen some improvement in the deposit growth also. And the gap between credit and deposit growth has narrowed. Overall, we are a little watchful of margins because after a very sharp improvement over the prior quarters, we believe that this will be the quarter wherein the cycle will start turning. And some banks will likely report compression in first quarter, which will only go on to compress further from the second and third quarter onwards.
Okay. Particularly, Nitin, wanted to get your thoughts in on HDFC Bank. Because according to, some analysts and even Abhishek was indicating, the loan growth is on the muted side, just up 1% quarter on quarter, I think 15% on a year-on-year basis. And the stock has slipped. Of course, the stock is also under pressure because of the kind of rise it's seen over the last fortnight. But particularly in HDFC Bank, what have you made of the update they've shared?
Right. So yes, both the advances and deposit growth numbers have come in lower than what we have put out in our report today. And after sort of a very strong quarter, what the bank reported on the deposit accretion, the expectations were naturally that they will continue to maintain a healthy momentum, not of the level of what Q4 was, because Q4 generally is a very high activity quarter. But if I look Q1, then Q1 has come in a tad softer versus what we saw in the Q1 of last year. And that has resulted in probably some sell down in the stock today. And but we will have to watch out as to how the growth unfolds, because the post-merger now, the deposit liability has to grow, the franchise has to grow at a much stronger pace to support the growth for the merged entity. And which is where it remains one of the key parameters for the stock to watch out.
Okay, got that. Nitin, the other trend that we've seen in the last couple of sessions is hectic buying coming back to the PSU side of the market, PSU Banks. So just in terms of profitability trends, that's obviously a catch-up trade that's started in the market now. But in terms of business trends, profitability, how they'll manage their margins, what are your expectations for not just the first quarter, but perhaps for the rest of the year as well?
Right. So PSU banks overall are likely to fare well, while many of them have already reached ROIs closer to 1%. But we believe that on one hand, though, you will see some increase in OPEX because wage provisions will be there this quarter, which wasn't in the base last year. So that will be a little bit of a drag. But overall, the benefit from the continued earnings growth coming from the NII, as well as the credit cost improvement that can still happen for most banks, that will drive the overall earnings. And add to it the treasury part, because now you are seeing a good moderation in bond yields versus what we saw in the previous quarters. So the treasury can also support earnings for these banks, and which is where this quarter in particular, we are looking at a 96% earning growth for the PSUs as a whole. And going forward, their growth rate will be a tad higher than the private banks is what we are looking at in FY24.
You're saying Q1 earnings growth for PSU banks will be 96%?
Yes.
Okay. And for the full year...
But that is largely because there were some banks, say, including SPI, which had a high treasury losses in the first quarter of last year. So the base is therefore relatively benign. Otherwise, on a sequential basis, our projected sector earnings for PSUs is still a decline on a sequential basis.
Got it. On net interest margins, this expectation of NIM compression, which will take place through the course of the year, is it priced into the stocks, or do you think come Q1 earnings when we chat with the management and they give a commentary on the margins going ahead and it could be a bit depressed, do you think the stocks will react negatively?
I think this is therefore a slightly tricky year because you will see margin cycle turning and the sort of expansion we have seen last year, wherein many of the large banks reported expansion in the range of 30 or even higher basis points. The cycle will turn, but to me it looks like that the decline will be more calibrated versus what the expansion has been. But second quarter can be a little worse off because which is when the pace of deposit cost increase, the repricing will be at its the peak. So which is where we'll be more watchful of the 2Q and the 3Q margins. And thereafter, it will all be a function as to how RBI moves on the policy rates. Because from the sectoral earnings perspective, we will be more watchful on FY25 than on FY24. Already, FY24 growth is lower than FY24.
Got it, Nitin. So I think the sense is that at least first quarter, everybody can breathe easy. Probably good loan growth, decent margins, enjoy the best of profits. We will start worrying a little later in the year, depending on how the rate curve moves. Got that. Just before we let you go, Nitin, another report that came out, I think from, I believe it was your team, that really caught my eye earlier in the week was Paytm. On a side note, I think you folks not only have a buy call on Paytm, but your target price is northwards of 1,000. And that's after what has been a phenomenal rally for the stock, right? I mean, it's rallied some 60-65% this year. So very quickly, just want to understand the premise. In a nutshell, we'll do a longer discussion on Paytm some other time. But, why do you like it now, despite this run-up?
Right. So, yeah, it was my report only on Paytm. And we have initiated coverage on the stock in April, and it has done well over the last couple of months. And we believe that the momentum in the disbursements, the gross merchandise value has been going strong. The company has released a business update today, which is close to the estimates that we have put out in our preview report. And we have therefore raised the disbursement estimates that is happening via the platform over FY24 and 25 slightly, and which is why we have raised our target further. Of course, fintech as a whole is an evolving space, and the progression, therefore, as to how this loan origination goes forward and how the regulator looks at this entire unsecured loan growth will be critical to see the trends going forward. But looking at how the performance has been so far, and every quarter numbers getting better in terms of contribution margins and the reduction in losses, adjusted EBITDA moving up, is why we have further raised our target. But we have not changed our target multiple when we raise the target.
Nitin, it's been a great conversation, and we hope to see you a lot more on the channel as we parse through the earnings that come through on the financial space. Thank you very much for joining in. By the way, ITC is... Thank you. ITC is pulling its